bit of a summary. I didn't mention the gold market. We really like gold. Okay, Robert Prechter, Elliott Wave. I should tell you, Bob Prechter, for those of you who don't know him, runs Elliott Wave International, biggest forecasting house in the world. Bob Prechter is a good friend of mine. I was one of the senior people at Elliott Wave for many, many years. So Bob and Dave Allman and Hochberg, if you know those guys, they're my very good friends. Here's the mistake, with all due respect, with that question. Does the stock market over the last 6 months discredit Bob Prechter and the Elliott Wave theory? With all due respect, Elliott Wave has no view on the stock market, any more than economics has a view on the stock market, or technical analysis has a view on the stock market. They are just methodologies. Please do not confuse the practitioner with the practice. So Bob has his Elliott Wave view. Well, I'm also an Elliottician, and we've done okay. Drew Baptiste, Morgan Stanley, he's my friend. He's an excellent Elliottician, and he's done extremely well. So Bob and Elliott Wave are not one and the same. So that's number one. Number two, I don't want to speak to Bob's view. I'm going to guess he's pretty bearish, but we're pretty bullish. So we've been bullish, he's been bearish. It's like saying to somebody, if Stephen says this on the economy and he's wrong, does that mean economics doesn't work? It's just a view, it's just a methodology. So that's what I would say. It doesn't discredit it, it really just doesn't apply.
Very good. Well, we have a technician that works with us, and I wasn't born a technician, I was born as a fundamentalist. So whenever he draws another line, I said, well, that technical analysis, just draw another line if it doesn't fit. But anyway, in our business, we use everything. You can't just use one philosophy, one theory, one ideology. You use whatever you can, because there are certain things that don't fall within the lines, and drawing another line doesn't make it any better. There are certain things that happen that are not forecastable events. So anyway, there are a couple of questions here for Luz, and I put them together. One of them is, what do you think about something pertinent to the day of Egyptian debt? I think the market is reopening, maybe tomorrow, or it's reopened already, I'm not sure. Would you buy, hold, or sell? And the next question is also for you. How have you delivered such strong returns over the past 15 years, and specifically since you have been a double line?
I'm sorry, could I get that again? Could I get that question again?
What's that?
Could I get that question again?
Sure. Why don't I give it to you?
Oh, okay.
Well, I read you
Perfect.
another one.
Oh, perfect.
And I'll read it out loud and give it to you also. Anyway, here it is. This is also for Luz, and I'll give it to you also. You mentioned risk-adjusted returns. How do you quantify risk in your sectors? Is it an art or standard metrics that are unique for your sector? So I'm going to give you all of them, and you can pick and choose.
All right. Well, I'll take them in the order in which they were given. In terms of Egyptian debt, at this point, to me, it's really not, it wouldn't necessarily be a prudent investment for us at this stage. I think there's still a lot of uncertainty, and until we get more clarity in the situation, I would avoid. And so that's that one. In terms of the returns at my previous employment and at DoubleLine, I think when it goes back to our basic fundamental sort of approach to the asset class. We think this is an asset class that is a secular improving credit story, and as such, there's significant opportunity to guide the investment your investment towards the credits that you think that we believe are going to take advantage of that improvement. And so what we do, it's basic analysis. We look at the credits. We on the sovereign side, we are looking at the credits that have the following three qualities. And for us, the most important quality is really a commitment to economic reform. And what we found on the sovereign side is that is really what has taken these credits from this Wild West to the investment grade category. I mean, it's what's taken the credits and has basically allowed them to clean up their balance sheets, to improve their underlying credit fundamentals. And it's that's one quality. The other one are credits that are plugged into the international, so they have strong linkages to developed markets, because that will help them in their development. And the last one, it's basically their geopolitical position, and that it's mostly because there's the expectation that some of the stronger developed economies or countries will provide support during times of stress, and we certainly have seen that in the past. Less important now, but in the case of Egypt, for example, I mean, that's part of the reason why the U.S. is all over that situation. It's a very important country for the U.S. to keep peace in the Middle East, and, you know, they have to be involved. And so, you know, for us, those are the three qualities that we're looking for. The one that we key off the most really is the commitment to economic reform, because that's what takes a credit from a single B credit to an investment grade credit. On the corporate side, we've developed a similar companion piece. We're looking for companies that are domiciled in the emerging markets but compete globally, and there's a certain big number of companies that do that. Companies that have strong credit fundamentals, that if they were domiciled in the U.S. or Europe, they would be investment grade rated companies, but because they're domiciled in Russia or Brazil, they're below investment grade at this point. Companies that have transparent reporting practices and strong management teams. Again, having been invested in this asset class for over 17 years, we've had the ability to really look at some of these management teams and have seen how they've responded to investors during times of stress, and that's very important for us, you know, to make sure that the team that's leading that company, you know, does have respect for contracts. And I would say probably the most important thing that we key off of is companies and sectors that are strategic to those economies, because those are the companies that we have seen, again, in the past, through our experience, are the companies that will receive support and have received support in the past during times of stress, which is when you need it. And so these are sectors such as banking, telecoms, utilities, natural resources. I mean, it's no surprise to me when you look at our experience here in the U.S. that the U.S. was all over the banking sector crisis. I mean, the U.S., the Treasury, lent a lot of money to the banking sector because they needed it to function. It works exactly the same way in emerging economies. A lot of these sovereign politicians, you know, pumped a lot of money into a lot of these different sectors to make sure that they functioned because they were needed to continue the operations of the country. And so to us, you know, it's that fundamental analysis that has allowed us to identify the credits that we think are going to move from the single B to the investment grade category. And when you move through that, through all those different rating upgrades, you know, you start to see spreads compress, and that's how you can achieve sustainable returns.
Thank you very much.
Did you want me to get the last one? Sorry.
Yes, go ahead.
Okay.
And Steve, I think if Jason, if you want anything to add, I think we could make it livelier.
I'd like to make a comment on Egypt, if I may.
Oh, yes, please.
As that was a question that was raised. I don't know what the media has been like in the States. I'm based in London. I only arrived here last night, so I'm actually half asleep this evening, given the time difference. But one thing I've noticed in the UK media is there's a tremendous optimism about changes coming through in Egypt, which is entirely understandable, given that we're seeing people power in action. But I think it's worth stressing that when we've seen people power in action in the Middle East in the past, it hasn't always worked in the way that perhaps the US or the UK or Europe would necessarily like. So just a few examples. People power helped to topple the Shah of Iran, but you ended up with a revolution that perhaps the West hadn't quite expected. People power led to democratic elections in the Palestinian territories, and the party that was elected was Hamas. People power led to democracy in Algeria, and democracy led to the election of an Islamic fundamentalist group, which was then immediately deposed by the military, who said they weren't having anything of that. So you then ended up with a civil war. My point about this is that although people power can lead to democracy, it doesn't always. You end up with all sorts of other alternatives. And so I think the situation in Egypt, yes, it may be something which turns out to be extremely positive, but that certainly isn't guaranteed given the history of the Middle East in recent times.
Oh, and then perhaps a final comment on Egypt. I mean, when we look at the Egyptian sovereign debt, and for everything that's going on, I mean, right before this social unrest began, Egyptian bonds were trading, 10-year sector were trading at around 5%, 5.25%, somewhere in that neighborhood. With all of this, they're probably trading at 6.5 or so. So for that level of potential return relative to the potential risk and uncertainty still in that particular country, I don't see how that is necessarily a good risk-reward trade-off.
Good, but thank you. I have another question follow-up to Stephen. How many months does Japan have until it becomes the next Greece or Ireland?
Well, this is an intriguing one for all sorts of reasons, because I've been asked that question for many years. When will Japan finally go bust? And Japan has a remarkable ability to increase its debt levels more and more year by year. In fact, one of the peculiarities a few months back was that people became very optimistic about the Eurozone because it was the Japanese who decided to buy some of these new European bonds. So the idea seemed to be that one heavily indebted part of the world would then be bailed out by an even more heavily indebted part of the world, and therefore the world's problems would be resolved, which was a very strange idea in itself. There is, however, something peculiar about Japan. Japan is very heavily indebted to itself. What I mean by that is that Japan runs a current account surplus. Japan, in terms of its government, borrows entirely from the Japanese people. About 98% of Japanese government bonds that exist are owned by the Japanese. So if there were to be a default in Japan, it'll be a default to itself, which philosophically is a very strange idea. Whereas when it comes to, say, Greece, 70% of Greek government debt is owned by foreigners. The incentive to default to foreigners actually is quite high because foreigners don't vote in Greek elections. But I'd also note that when it comes to the US, 50% or so of US treasuries are owned by foreigners, which is why I mentioned before that the incentive for the US to go for a dollar devaluation is extremely high because it's the foreigner that picks up the price rather than the US itself. So I think the big difference in Japan is because it's indebted to itself, it's a very funny kind of indebtedness, and for the time being, therefore, it's probably capable of coping with these relatively high levels of debt.
Great. Anybody wants to comment on Japan? I guess, we've gone over that a little bit already. So this is a question that anyone, could pick on. What about the China-India effect? Will China's aging population be the primary consumer of the U.S. biomed products? Will this fuel the next bull market over the next 5 or 10 years? And